You have $500 sitting in your checking account right now, and it is currently the most dangerous money you own. It is caught in a silent war between the person you are today and the version of you that exists 40 years from now. You think this is a small choice about a weekend trip or a new gadget, but you are actually deciding who gets to own your time. You are either buying a temporary distraction or you are laying the first brick of a financial fortress. Most people treat $500 as a finite amount of consumption that will eventually gather dust. They don't see the biological potential of those dollars to grow into a multi-million dollar empire if left undisturbed. We are going to look at the math of the mid-month decision and why $500 is the magic number for your future. This isn't about skipping coffee. It is about the structural engineering of a life where you never have to work again. Right now, the average personal saving rate in the United States is hovering between 3% and 3.8%. That is a dangerously low ledge to live on, and it explains why the majority of the population feels constant economic anxiety. If you can find a way to automate $500 every single month, you aren't just saving more than your neighbor. You are officially opting out of the national average and entering the realm of the wealthy. Only 69% of adults in this country can cover a simple $500 emergency with cash. By investing this amount monthly, you are building a fortress of solitude that protects you from the unpredictability of the world. Let's look at the cold, hard numbers provided by the historical performance of the stock market. Over the long term, the S&P 500 has returned a nominal average of roughly 10% every year. In your first 10 years of contributing $500 a month, your total out-of-pocket contribution is $60,000. But thanks to that 10% return, your account balance will actually sit at approximately $102,400. At this stage, the growth feels slow, almost like a rounding error compared to your effort. This is the period of the invisible growth where most people get bored and walk away from their own success. But if you stay disciplined and reach the 20-year mark, the math starts to change its tone. Your $120,000 in total contributions has now blossomed into a balance of $379,700. Suddenly, the market is doing more heavy lifting than you are. You have crossed a threshold where the interest earned is starting to rival the amount of labor you put into the account. By year 30, the gravity of your wealth becomes undeniable. Your $180,000 investment has crossed the million-dollar milestone, sitting at roughly $130,200. This is where the crossover point occurs, the moment your capital becomes a more significant driver of growth than your job. You are no longer the engine of your wealth. You have become the passenger in a high-speed vehicle. If you can maintain this habit for a full 40-year career, the final number is staggering. That consistent $500 a month turns into a total of $388,400. Think about that for a second. You only contributed $240,000 of your own money over those 4 decades, yet you end up with over $3 million. This is the sheer, unyielding force of compound interest when it is allowed to run without human interference. It is a reward for the patience that 97% of the population simply does not have. However, we have to talk about the inflation tax, because $1 million today won't buy $1 million worth of goods in 40 years. Average long-term inflation sits around 3%, which eats away at your purchasing power over time. When we adjust for that 3% inflation, we look at the real return, which is historically around 7%. In today's purchasing power, your $3.1 million will feel like roughly $1.3 million. While that might seem less impressive, remember that $1.3 million in today's dollars is still a massive fortune. It provides a level of security and freedom that most people will never experience in their lifetime. Now, where you put that $500 is just as important as the act of saving it. Modern tools have made it easier than ever to build this empire without needing a degree in finance. The first rule of the master researcher is to always capture your employer's 401k or 403b match. This is the only place in the world where you get a guaranteed 100% return on your money instantly. Never put a single dollar into a taxable brokerage account until you have maximized that match. To ignore the match is to turn down free money that your future self is begging you to take. After the match, the Roth IRA is your best friend for long-term growth. Because you are investing post-tax dollars, that $3 million nest egg could be entirely tax-free when you withdraw it. Imagine reaching retirement and knowing that the government cannot touch a single cent of your gains. That is the ultimate strategic win in the game of wealth building. If you need more flexibility for midterm goals, a taxable brokerage account is the way to go. It doesn't have the age 59.5 withdrawal penalty, making it a powerful tool for those looking to retire early. In 2026, the platforms available to us are more sophisticated than anything our parents had. Platforms like Fidelity and Vanguard remain the gold standard for low-cost S&P 500 index funds like FXAIX or VOO. But we also see new features on apps like Robinhood, which now offers AI-driven agents to automate your trades. They even offer a 3% match on IRA contributions for their Gold members, which is a massive boost to your principal. Other tools like M1 Finance allow you to use pies to automate your $500 across a custom portfolio. This ensures that every single dollar is instantly split according to your target percentages without you lifting a finger. If you want to optimize even further, robo-advisors like Betterment or Wealthfront handle something called tax loss harvesting. This automated feature can add about 0.77% to your annual returns by strategically managing your losses. It might not sound like much, but over 40 years, a fraction of a percent can mean hundreds of thousands of dollars. In the world of high-level investing, the game is won in the margins of optimization. One of the biggest mistakes people make is waiting for a dip in the market to start. They spend months or years watching the news, waiting for the perfect moment to deploy their cash. What they don't see is the unsent invoice, the permanent cost of that delay. Missing just the 10 best days in the market over a 20-year period can literally cut your total returns in half. Time in the market is always more important than timing the market. The $500 you invest today is worth infinitely more than the $600 you might invest 3 years from now. Another critical strategy is the use of fractional shares. You don't need to wait until you have enough money for a full share of a high-priced ETF. Modern apps allow you to buy exactly $500 worth of any asset, ensuring your money never sits idle. Idle money is money that is being slowly dissolved by the hidden asset of inflation. You should also look into automating the increase of your contributions. If you set your monthly deposit to increase by just 1% to 3% every year, you are performing a lifestyle creep reversal. This small adjustment can turn a $3 million retirement into a $5 million retirement without you ever feeling the pinch in your budget. It is a way to trick your brain into building massive wealth on autopilot. There is a psychological hurdle we all face in the 4th year of our journey. This is the invisible year, where you've been disciplined for 36 months, but the balance still looks small. You look at your screen and see a number that feels like a rounding error compared to the sacrifices you've made. This is the valley where most people quit because the feedback loop is too slow to feel real. You have to realize that wealth is like a structural wall in a building. For a long time, you are just digging a hole and pouring concrete, and it doesn't look like anything is happening. But once the foundation is set, the structure begins to rise with a speed that seems impossible. Your job is to stay rational when doing nothing is the hardest possible action you can take. The latte factor isn't really about the coffee you buy in the morning. It is a metaphor for the decision to automate your financial life so that human emotion is removed from the equation. When your $500 is taken out of your account before you even see it, you stop negotiating with yourself. You stop wondering if you can afford that new pair of shoes or that expensive dinner. Wealth starts on a mundane Wednesday afternoon between two things you were supposed to be doing. It starts the moment you stop meaning to start and actually open the account and set the transfer. There is no ceremony for the beginning of a fortune. There is only the quiet click of a button that commits your future to a path of exponential growth. As your balance grows, you will notice a loneliness of the long term starting to develop. You are moving in a different direction than the people around you who are spending everything they earn. You aren't superior to them, but the distance between your foundation and theirs will eventually become very real. Having a fortress underneath you changes the way you interact with the world and the risks you are willing to take. By the time you reach level 3 or level 4 of this journey, your focus will shift from saving to optimizing. You will start caring about risk-adjusted returns and the gap between an unexamined portfolio and an optimized one. When you have $500,000, a 2% improvement in your return isn't just a nice dinner, It's a $10,000 annual raise. This is when the math of your life officially changes and the percentages start to have real teeth. You will transition from managing your money to making strategic positions. You will evaluate every investment on two axes: the expected return and the absolute worst-case scenario. But all of that complexity starts with the simple, boring habit of $500 a month. It is the fuel that runs the machine, and the machine doesn't care about the size of the fuel, only that you keep feeding it. Don't let the embarrassing smallness of a monthly contribution stop you from building an empire. Nothing stacked on top of nothing will always be nothing, but $500 stacked consistently becomes everything. Your future self is either going to thank you for the fortress you built or pay the price for the distractions you bought. The invoice is being generated right now, and the only question is who is going to pay it. Stop waiting for the conditions to be right, because the conditions are never perfect. Open the account, set the automation, and let the math of the universe do the work for you. This is the path to the crossover point, where your labor ends and your freedom begins. It starts today, it starts with $500, and it starts with the decision to finally own your future.